Let's talk about the markets right now. Joshua Wine is the Vice President and Co-Portfolio Manager at Hennessy Funds. He joins us from Raleigh, North Carolina. Joshua, fantastic to have you on the show. Interesting tone in the market today. We had weakness in the Chinese stock markets overnight. Then we had the US manufacturer 3M reporting weaker results. China, Europe, you name it, weakness. And the market got a bit nervous here.
It did, Julia. Yeah, the morning was interesting to watch, so we had some interesting earnings data, obviously. Facebook and Microsoft, strong reports, a lot of growth. I think we all know what's going on, at Facebook and Microsoft. Most interestingly, I would say are two things. One would be 3M, which you mentioned, the worst day in 32 years. And I think investors look at that as a great source of information, so it's more than Post-it notes, as we know. It's telecommunications and healthcare that's embedded within this company, and industrials, and a little bit of everything, adhesives. So it's not sexy, but it says a lot about, at this point in the cycle, what investors care about, at least initially. So initially it was, maybe things are slowing. We've had reports out of Europe and most recently South Korea. Some weak GDP numbers. But then to your point, Facebook and Microsoft, certainly today gave a bid to the market, at least the S&P. And so, it's been interesting to watch, to kind of get a sense of what people care about. And right now it's growth.
It's interesting to watch what's going on in the bond markets at this stage, too. If you look at the session yesterday as well, bonds were going up, stocks were weakening. We saw rates coming right down. I mean, the market's very bearish about what's going to happen. I mean, the Federal Reserve could even cut rates this year. What's the risk that we see a bumper growth number tomorrow in US GDP numbers and suddenly the market goes, yeah, we're okay again?
That's right. Yeah, that's a great point. So looking at the bond market gives a lot of information. So 3M gives you a lot. Looking at the bond market this morning, infinitely more information. So, the idea, looking at Fed fund futures and what does that imply for a rate cut over the next 9 months, it's a nearly 70% chance of a rate cut in the next 9 months. So, GDP tomorrow, obviously, people will be paying attention to that. I would argue maybe not quite as much as one might think. I think, the Fed is front and center. It probably shouldn't be that way. There's a lot of great growth stories out there, the U.S. economy, U.S. corporate growth. But ultimately, it's about a rate cut and how accommodative will the market be. And right now it seems like the Fed is on the same page as the market.
Yeah, it's not doing anything. It's sitting on its hands. It's being patient. And yet 2 seconds ago, I was just talking about near record highs for these markets, a record high for the NASDAQ right now. So as an investor, when the message the bond market's saying to you is, look, we've got a growth problem here, when you look at China and you get nervous there as well, what should investors be doing? Because I see lots of confusing signals here.
Sure. Well, it's a great question. It always comes back to, how do we use what we're learning from what the market's telling us? And we would argue at Hennessy, is to stick to a plan, be disciplined, have some kind of a repeatable, disciplined process. We focus on value and earnings growth and stock price momentum, and don't get too involved. It's great to get a feel for what's going on in the economy and around the world. But ultimately, it's about staying disciplined and having some kind of a process. So I think people should stick to their plan. There will be pullbacks inevitably. Most likely, given where the Fed stands, it's a great time to add to positions, add to funds, top up the equity allocation for those that are a little bit underweight their target. But I would argue doing nothing is not the worst decision here.
So if January, in hindsight, which admittedly is 2020, was a great buying opportunity, you're saying at this moment, perhaps keeping a higher allocation of cash, sitting on your hands here, not the worst thing to be doing?
Well, yeah, I think for those with cash, when there are pullbacks, I think the market, the Fed is watching quite closely. It's clear that, that they are going to be accommodative. The ECB is going to be accommodative. The Bank of Japan, we're awash in liquidity. And I would actually say, getting back to your question, for those with cash, certainly on pullbacks, add to positions. And for those, even without a pullback, I think that it is hard to argue with the idea that with the 10-year around 2.5 and the market's kind of earnings yield well above 5%, margins expanding, we're not over levered as a, as a corporate society here. So it's a good setup, especially with the market near highs. It's a good setup for a leg higher.
Yeah, it's tough to call it. Joshua Wine, thank you so much for wading in. Yeah, it's tough. Great
Thank
to
you,
have
Julia.
you on the show.
Appreciate it very much.
Thank you.